How much should you put down on a house? That is a great question. And the answer is it's specific to you. In other words, your scenario is unique because it is you. There's only one of you. I do like when percentages are discussed in terms of percentages. I do have some folks say, man, I want to put down this many dollars. I'll explain why in this video, why percentages are what I would recommend you talk in, because it has an impact on a lot of things, the type of program, the rate, and mortgage insurance or the lack thereof. So let's talk about how much you should put down on a house, right? So first and foremost, we got to consider a whole bunch of things, right? We got to look at the strategy and the decision for why we're going to put down what we put down. First part is going to be leverage, right? How much do we want to actually borrow? How much do we need to actually borrow? What's the risk? Meaning, if you put down all your cash reserves, how much is left in the bank to where if something happens, you can actually like still live, right? Because you don't want to be house poor. We still need some money in there. And then what are the opportunity cost? What else could you do with that money? So a lot of times people think, oh man, I need to upgrade the kitchen or do this or do that. Well, sometimes that might mandate that you put less down and keep more money liquid to do those type of repairs. So those are the things that we're going to consider. It's all a trade-off, right? We're not trying to necessarily maximize our ROI. We're not trying to minimize our payment. It's just going to be finding that sweet, delicate balancing between what it makes sense and how much you should put down on a house, whether you're buying in Dallas, Texas, or just anywhere in Texas or the United States for that matter. It is this combination of finding the sweet spot between building wealth and then also that financial stability, right? Because some folks will say, oh, more is better. More is not always better. So let's go through that. So what do down payments do? Let's first talk about loan to value, LTV. If somebody were to buy, and let's keep it really simple today. And if I know there's not a lot of $100,000 homes out there, but just for easy math, if somebody were to have a 10% down payment on a $100,000 home, that means they're putting down 10 grand, which is a loan to value of 90%. So the $90,000 loan divided by the purchase price, that's your loan to value. And why is that important? That's what we, the mortgage industry, we use loan to value. We talk in those numbers that determine your eligibility for certain underwriting guidelines, whether or not mortgage insurance comes into play. That LTV certainly means that it will impact your interest rate, right? A higher down payment or a bigger down payment, you get a lower loan to value. A lower down payment, a small, tiny down payment, you're higher leveraged, so you have a higher loan to value, LTV. And a lot of these things do come into play as far as when you have these loan to values. It does impact things, like I said, underwriting guidelines, as well as reserves, like how much money you need in the bank after you're done. Bigger down payments can also warrant, depends on the program, but it can mean that maybe you don't even need an appraisal because if you put so much money down, you're minimizing the risk. And therefore, sometimes you don't even need an appraisal and you get a property inspection waiver. So that's really cool. So again, when folks talk about how much they should put down to buy a home, the reality is if they're trying to maximize, I'm using air quotes, maximize my returns, they're looking for like, okay, what's my biggest ROI? Because here's the reality. The house is going to appreciate no matter what. So in my example on a $100,000 home, whether or not somebody paid cash for it or they get a loan, it's going to appreciate no matter what. So some folks say, well, what's the return on cash? Well, if they get in with a zero down loan, let's say they put no money down and the home appreciates, let's just say 5% in 1 year. After that 1 year, the home goes from 100,000 to 105. They've just made 5 grand by not putting any down payment. That's like an infinite return, right? If they put down, let's say they put down 5% and the home appreciates that same, 5 grand, they've made 100% return on their money, right? So the return on cash, they put a $5,000 down payment down and they got 5 grand of appreciation. That's 100%. Likewise, or conversely, if somebody puts 50% down, so they get a $50,000 loan and they get a $5,000 return, in my example, you put down 50 grand, you make five grand, that's 10% return on their money, not the, 100% return that we just talked about. So there is this part where we talk about trade-offs. And like I said, we'll talk about mortgage insurance and PMI and stuff like that. So some of the key levers, right? So let's talk about when somebody's thinking like, how much should you put down on a house? Some of the key levers that come into play, right, is going to be the obvious. First and foremost is like, what's the monthly payment? Right, that's number one. Is like, hey, what does that mean? Right, the bigger down payment means bigger down payment means smaller payment each month. That makes sense, right? That helps you in terms of qualifying, right? Because there's less income, or less liability maybe makes you more comfortable where you can afford it better. And then from a qualifying standpoint, again, it's lower DTI because there's less debt. So number two, we got to take into consideration is mortgage insurance. Well, private mortgage insurance, which is PMI. Depending on the loan type, it's also called like MIP sometimes, or I just call it MI. So on conventional loans, when you put down less than 20%, you at least have to have a conversation about PMI. There's ways to buy out of it, but the reality is it does exist, or at least you need to have that conversation. That's for conventional loans. And so what we would then have, mortgage person to home buyer, we got to talk about break even and is it worth it? If you have the money, should you put it down? Things like that. The third thing, when you consider, the third key metric here is your interest expense, right? You put a bigger down payment, you're going to pay less interest over time. So the other part, like we talked about earlier, which was opportunity cost, let's compare that cash and what it could have done somewhere else, whether it's in maybe remodeling the kitchen or if it's already sitting somewhere like in a 401k and it's earning some type of return. That's some conversation, that has some bearing on the conversation, right? As far as what we do and whether or not we need to do something. And along those lines, the fourth is like liquidity. If it is in a 401k or if it is in some type of stock or brokerage account, what is the risk leaving it there versus using it to put a bigger down payment? We don't want somebody to be like house rich and cash poor. We do recommend having some reserves, whether it's, the liquid 3 to 6 months and then some more in semi-liquid accounts. But those are all really big, important conversations to have. So now let's talk about, as I said earlier in the or earlier on this, I like percentages. So we're going to talk about how much should you put down on a house in terms of percentages, the optimal down payment range, if you will. So there absolutely are programs where you can put zero down. Not everybody qualifies for them. Sometimes those zero downs are, the most obvious and easiest is veterans. God love you, veterans. God bless America. The veterans do have options for zero down with VA loans. There's USDA. In Texas, there's TSHAC and TDHCA, and there's all kinds of bond programs out there that can allow folks that have down payment assistance to do zero down. Conventional, like Fannie Mae, Freddie Mac, those type of loans, they'll typically allow like 3%, 5%, 10. So once you get to the 5% number, so 0, 3%, 3.5%, because 3.5 is FHA, 5%. After 5%, my absolute recommendation is try to operate in intervals of 5%, 5% down, 10% down, 15% down, 20. And at 20%, the mortgage insurance does go away, right? Whether or not somebody should stretch to get there to be determined. Because again, I would rather have let's just say it's 10 grand extra in the bank or pay an extra $100 a month buying there. Let's say it's a first time home buyer and even a third time home buyer. There's always expenses, moving expenses, furniture, and all the new stuff that goes with getting a house. So I don't know that I'm like, hey man, you got to do 10%. I really don't think so. I feel like any interval of 5 where we find that sweet spot between, do we need 20%, 10%, 5%? It's balancing that to where you still got money in the bank so that you're not hurt in case life happens. And then up to 20 or 25%. So again, if you're buying an investment property, it's going to be different than if you're buying your first home. So again, the program a lot of times dictates what that down payment should be. So the average down payment on a house in Texas, I actually tried looking this up. Obviously, I have our internal data, but that doesn't mean I represent, the entire state of Texas. I wish I did every loan in Texas. But I would say the majority of what we do puts down less than 20%. A lot of first-time home buyers don't have that 20%, understandably. It's not necessarily, like I said, it's not the target. And if you're buying in Dallas, for the Dallas down payments, a lot of it depends on where you're buying and the property taxes that go with it certainly come into play because, again, that's really can be expensive here in Dallas. So we do have a down payment calculator that if somebody wants to use it, it's part of our home loan toolkit. If you want to see how much you should put down on a house, then use the down payment calculator. You can run multiple scenarios, see what the cash to close is, see what the PMI is, that mortgage insurance, see what how much money you have left once you know what that looks like. And then on the down payment assistance programs, right, you can look to see what kind of grants are out there, the forgivable loans. And that's, again, our job as lenders to walk you through that. And we'll absolutely do that. But check that rate. We'll go through and say, okay, here's where putting this much more down, you maybe get a little bit better rate. Not enough to where we want to sit there and say we have to go for it, but we do want to make sure we educate you guys on what that looks like. And then also the savings, right? So folks are like, man, how much should I put down? What's the optimal amount? Again, and we talk through it. And let's say we hit a certain number, like, hey, we do need or want this, right? Whether it's for qualifying purposes or just that's their goal. There are some saving tactics, right? So aside from just, wishing and hoping, let's get a plan in place. A big part we always recommend is maybe if you have a separate account that's set for your down payment, you can set up auto transfers. If you got to pay off some debt first, maybe we do that before we start saving, pay off some high interest credit card debt, get all that going. But ultimately, if we get a full plan, a full picture of what we're doing, we can say, okay, going conservatively, we can save up this many dollars in this amount of timeline. And then that way we at least have a plan for what we're doing. So, really and truly, like I said, all these things come into consideration for how we do this. And ultimately, number one, if you're starting to save and figuring out how much to put down for a down payment on a home, I would say figure out what you need for reserves first. How much money do you need in the bank to make sure you feel good, a little safety net. Number two, start looking at scenarios, get pre-approved or pre-qualified with us, right? The Mortgage Mark team. And if you go through that, figure out, do you want to put down 0, 3, 3.5, 5, 10, 15, 20? Let's price out those scenarios using our down payment calculators. And then 3, find that sweet spot. Just because you can doesn't mean you should. So let's find that and then get a plan in place that says this is what we're doing. And we'll make sure we maximize your cash return. We'll make sure we align with all your just cash position. It'll, like I said, we'll look at your market, where you're buying. We'll look at just the broader financial plan. And we'll just run a whole bunch of analysis to where you and us, we can get a plan in place that says this is what we're doing. So if you do have more questions or need us, certainly you can reach out to us. Mortgagemark.com is our website. We're happy to talk through how much should you put down on a house. And remember, as always, when you think mortgage, think Mark.